Well, last but not least, we're going to get an overview of the oil and gas industry and hear from somebody who's worked in it for a good many years, both as a consultant and analyst. He's worked for Canaccord Genuity. He was head of UK Oil and Gas at Natixis, Seymour Pierce, Charles Stanley, Rockhopper and others. He is Richard Slape.
Good evening, everybody. Does that make that work? There we go. I haven't got very many slides for you, so we'll probably make up a little bit of lost time here. I'm just going to spend 10 minutes just talking about some of the things that it might be worth you thinking about before you stick money into the small cap oil and gas E&P space. A quick disclaimer there, which I think tells you that I don't know what I'm talking about. And then just, a couple of lines about me. I mean, Nigel's really introduced me already, but there's a few logos there from some of the companies I worked for. I spent 26 years working for various sort of stockbrokers and investment banks, principally as an equity analyst, but always looking at the small cap E&P space. And then in 2012, I joined Rockhopper as their business development manager, which I was doing for just under 2 years before I went on the board of Lansdowne Oil and Gas, who were with Providence Resources offshore Ireland, and in fact I think are going to be drilling a few wells this year. Latterly, Hopeton Petroleum really is just my vehicle. I work now on a consultancy basis for a variety of financial institutions and oil and gas companies, doing data room trawls, financial modelling, research reports, all that sort of good stuff. So small cap oil and gas companies, what I learned over the years, the sad reality is that certainly in the last sort of decade or so, there's been a lot more losers than winners. And the first chart you can see up there, text may be a little bit small, but that's the FTSE AIM All Share Oil and Gas Index. And you can see the sort of run up there in the early part of the 2000s, really starting, I think, in 2004. The oil price took off. We had our own sort of little version in the E&P space of the dot-com boom, and investors couldn't get money into the space fast enough. The collapse there is the oil price going down from sort of 150 to 30 in 2008 before we had a recovery. But really in the last 10 years it's been a pretty dismal place to invest. By contrast, if you'd invested in the larger stocks, the chart below is the FTSE All Share Oil and Gas Producers Index, obviously dominated by BP and Shell. Actually, if you'd invested in them, you've kind of done okay. Probably not quite as well as the market since the sort of since 2002-3, which was the sort of low point on the chart there, but not far off. So, frankly, that's been the place to have your money in the oil and gas space if you look at it on a long-term basis. Now, look, that's not to say there haven't been some spectacular successes in the E&P space. Plainly there have. But for many investors, all those gains will have been, wiped out and, perhaps several times over by the even larger group of equally spectacular failures. And I think one of the things you perhaps need to do in this space is, before you start trying to pick winners, is try and work out, the ones which are genuinely high risk. And, if you put your money into them, you may well end up with nothing in fairly short order. And whilst that may result in you, missing out on a few spectacular gains, I think it'll save you money because you will miss out on even more spectacular losses. And I think you need to ask yourself, how much of your portfolio and how much money do you want to invest in a company which is potentially focused on just 1 or 2 licenses, exploration licenses, and with no reserves and production. And the reality is they make up the bulk of certainly the small cap E&P space in the UK these days. I was looking at a chart the other day of on FactSet, they identify 78 UK E&P companies. Only a dozen of them have got market capitalisations greater than £500 million. And the bulk of them are sub £100 million. And the biggest group by far was the sub £20 million group. So really it's a kind of a micro cap space. One of the big issues, I think, is that investors have a tendency to, well, they don't tend to price risk appropriately. And I don't think they're entirely to blame for that. I think the industry has been, remiss in the way at times it's presented, particularly exploration plays. And, the two big bugbears of mine is, one, we're always being told what the Pmean prospect size is. Well, frankly, we don't value Pmean reserves. We value P50 reserves. So you want to know what the P50 number is, not what the Pmean number is. And 9 times out of 10, the Pmean number will be bigger than the P50 number. And that's particularly true, I think, in some of these very exciting but high risk plays where the upper end of the potential reserve size is not quite unconstrained but can get very, very big, and that has a tendency to push that Pmean number out to the right. I'm aware of situations in the past where the Pmean has been around sort of P35, that sort of number. So quite a long way from P50. So I would always advise you, if you're presented with a Pmean number, if you can, ask the company what the P50 number is. And I would tend to base any valuation that you might sort of come up with on the P50 number, not the Pmean number. I think the other thing that you need to be aware of is chance of success. Almost always it's the geological chance of success which is quoted. Now, geological chance of success can be anywhere from literally P1 to the P99. The P99 number may not be commercial. You may have to come sort of quite a long way down the curve before you get to a resource number that's going to be economic. So what does that mean? Well, it means that commercial chance of success is, in all likelihood, significantly lower than the geological chance of success. So if you're sitting there valuing the prospect on the basis of the Pmean and the commercial chance for success, I would contend that you are at the optimistic end of the spectrum before you've even started. So the chances of you being disappointed are higher than they should be. Management, I think, is absolutely critical when you're getting to know management is absolutely critical when you're investing in the E&P space. I would say that a lot of the E&P companies are a reflection of the personality of their CEO, and over the years, I think in the early days, Cairn Energy, for instance, was a reflected sort of Bill Gamble's personality. Tullow obviously reflected Aidan Heavy's personality, and the list goes on. So, I think it's important that if you can, you meet management, you talk to them, you try and get to know them, and try and work out what it is that they're trying to achieve and how they want to go about doing it. And not everybody's trying to achieve the same thing. Some companies, some management teams want to build a business. They want to build a full cycle E&P company and be producing 100,000 barrels a day and paying dividends and all the rest of it. Others very happy to try and work up a prospect or two farm them out or not, or sell the business and exit much earlier in the E&P cycle. And it's important that you understand what it is they want to do, how they're trying to get there, and actually what's their time frame for doing it, and does that coincide with your own investment horizon? I think the other thing, if you get you should think about is go back, look at management's track record, and you will kind of work out that there are some management teams who tend to under-promise and over-deliver, and there are other management teams who have a tendency to be a bit more optimistic. They might over-promise and under-deliver. Now, all of that's fine, but you need to understand kind of where on the spectrum that management team sits. And I think, adjust your expectations accordingly. A lot of companies will tell you, a lot of CEOs will tell you, and I don't think this is something that just applies to the E&P industry. I suspect it applies to all industries. But CEOs, of course, always think their shares are too cheap, and they can't possibly issue any more stock because it would be too dilutive. And obviously, you don't want the company to be run by people who are just issuing stock constantly and not thinking about the consequences of doing that. But equity can be a currency. It can be a very useful currency for an E&P company. And let's not forget that the E&P business is capital intensive. So equity can be a really useful currency. And if you refuse to transact or do things because your shares are too cheap, your company won't stand still, it will go backwards. Because at the very least, you're just going to be burning your G&A every year. So I think it's really important that companies are willing to do, within reason, what it takes to keep their business moving forward. And I think the other great success story in the E&P space, I talked briefly about Cairn a minute ago. The other great success story in the E&P space over the last sort of 15 years, of course, has been Tullow. And to his credit, I think in the early days, Aidan Heavey was always willing to do a deal and issue equity to get the deal done. And let's be honest, had he not done the Arco deal, had he not done the Energy Africa deal, Tullow would not be the business it is today, and investors would have missed out as a consequence. That's really, I think, the main points that I wanted to make. So, as I said, so we get through it quickly. 30 years condensed into about 10 minutes. But the sector has been a tough place to make a profit. So, try and work out and avoid the losers rather than necessarily just sort of, going out and trying to pick the winners from day one. None of us can see underground. The industry, has a tendency, I hesitate to use the word misrepresent, but has a tendency to present risk in a way that, may not give you the most likely, outcome. And, publicly at least, all CEOs think their shares are cheap, so, don't necessarily believe them when they say it.
Well, we can ask them, can't we? Thank you very much indeed, Richard. Very good. Well, we'll ask the panel in just a moment, but questions, thoughts about your own portfolios perhaps, or this sector? There's a question right here.
What are your thoughts on global RP ratios? If the numbers are to be believed, we should probably stop exploring.
Reserves to production ratios?
Correct. Yes.
Well, I think people are exploring less, right? That is the reality. A lot of the big companies, are leaving the North Sea, or they're leaving. They're giving up into their international businesses and they're heading back to the US and investing in resource plays. So, RP ratios, for sure are quite high. I think the question is that at the moment that's sort of a little bit unanswered is that you've got obviously enormous resource in shale, But what's not clear to me is, we kind of know that if you're operating in the North Sea, an RP ratio of about, you can probably live with an RP ratio of about 10, right? I don't know what the RP ratio is for those kind of resource plays, right? Because the resource is enormous. I'm not sure realistically, how much of that you could expect to produce in any one year. But look, there's a point well made, and I think actually, you can see the industry's response is there for everybody to see. They're not exploring in the way they were.
I saw some figures from the International Energy Agency. They estimate the world needs to invest $580 billion a year to keep oil and gas growing. 3 years ago, the investment was $350, and it's crept up. $370 2 years ago, $410 this year, with a bit of luck. So, yes, I mean, there is a lack of investment here, and clearly all these companies are battling to get a share of it. I'll ask you about your kind of where you feel your share price sort of perception is, but let's just get the question first.
I wonder if you've got a view of UK oil and gas.
No. Certainly not one that I would, talk about in a forum like this. I'm not going to answer questions about specific companies. I'll answer generic questions about the industry, but not about specific companies.
Have you got a view about the Wheeled oil field that seems to have been discovered, and they've generated significant flow rates from the wholesale well?
I think the
could be replicated elsewhere.
Yeah, I don't have a technical background. I do know a little bit about the Wheel Basin. In my view, it's quite an interesting play. I think that sort of hybrid. They call it sort of. I think Angus Energy likes to call it a hybrid play, and I can understand why, because it's a naturally fractured shale in effect. So you don't need to hydraulically fracture it, or at least that's a theory in order.
It's a conventional play.
Sorry?
It's a conventional play. There's no.
Well, you don't need to hydraulically fracture it because it's naturally fractured. Right. I think is the point. And there's certainly a view that it's laterally very extensive across the Wheel Basin. So look, we'll see. Obviously, Angus is having a few problems, I think, with Brockham at the minute. But I think it's really interesting. The problem you always come back to onshore the UK, and particularly in the southeast, is going to be planning. Right? Nobody wants this stuff. Well, they want the oil, they want to drive their Range Rovers, but they don't want drilling rigs and trucks and all the rest of it in their backyard.
Except the local authorities are going to be getting big cuts from the revenue that's generated. So it's predicted about £1 million a well going to the local authorities.
All right. Well, thanks.
Well, not
very much
not if you want to get re-elected. It may not be right.
I'm sure you can continue this afterwards. There's a question here.
I was wondering if you had a view on the following. I find it interesting when I read the FT every day, and I read about university pension funds and sovereign wealth funds that are pulling money out of the oil and gas sector because it's no longer morally acceptable to invest in the sector. How do you think this is influencing the world of investors in this arena generally?
Well, I think the E&P space, in my view, is still not looked upon terribly favourably by the UK institutional investment community, and and added to that, I think these guys. Well, the problem, one of the issues they're facing is that the specialists who used to sort of cornerstone a lot of this stuff just aren't there anymore. Either because they're investing in the resource plays that we just sort of talked about, or because actually they didn't do very well. They suffered in the downturn in sort of 2015, 2016, and they simply don't exist anymore. So I think it's certainly hard for small and mid-cap E&Ps, or harder for small and mid-cap E&Ps to raise money in the UK than it was at certain points in the past. Look, you're absolutely right. A lot of funds now are backing away from oil in particular. It doesn't necessarily apply actually to natural gas. I think there are some people out there who said we're not going to do oil, but we also do natural gas, which they see as a sort of cleaner, more environmentally acceptable fuel. What does it mean? Look, I suspect what it means is that more money will ultimately be invested by people in the Far East or India or wherever it is, who I suspect will have no such qualms about investing in the oil and gas sector, and they need energy. The global population goes up day by day, and I think it's very easy to sit here in the UK and look out your door and there's a Tesla and a Toyota Prius and think the end of oil's just around the corner. But frankly, most of the world's not going to have the luxury of buying those kinds of vehicles. They're going to be using fossil fuels for a long time to come, in my view.
Well, I was making that point at the beginning about John Hess saying that oil and gas will be a major part of the mix for at least 15 years, and that's got to come from somewhere. We're almost reaching the end of our time. I would like to just ask the panel to just comment briefly. I mean, Richard said all chiefs think their share prices are too low. You can comment on that if you wish. But it's also just being able to raise money in this environment that we've been talking about when there is scepticism around. Paul?
It's like anything. If you have a good project with good management, you will raise money. And the quality of the opportunity will still determine the market response. We raised $110 million in the summer of last year because I think we had a great project. At a time when we were told, the market wasn't receptive to oil and gas, and we were heavily oversubscribed. Also because it wasn't an exploration project, and I do think genuinely it is harder for explorers to raise money too. And the fact that we're converting investment to cash flow almost immediately, I think does make a difference. And the point about investment horizons and people's willingness to wait for exploration to turn into cash flow, I mean, that does make exploration, I think, more challenging in the marketplace. And so, that's difficult. But in the end, if you are looking to maximize hydrocarbon recovery, you do need, all of those different aspects in order to do that. You've got to have exploration, and you've got to have efficient development and production.
Well, Jeremy's got plenty of exploration on his plate.
Well, yes, but we're not trying to finance it, and I wouldn't. I mean, investor sentiment is very negative on exploration at the moment. It's been negative on the whole sector for a while. There was a time when you wouldn't get past the words oil and gas before you were already seeing a sort of look of distaste and a slight curl of the lip. But now at least you can get to production and people are happy. But exploration is still very much no-no. And there are good reasons for it, because the thing about exploration is it's a very long cycle from exploration to cash. So how are you going to monetize the investment? Now, there was a time when there was a model for this, and it worked very well about 10 years ago. You farmed out, you got a carried interest, someone else was paying most of the way, and then you make a discovery, or you don't, and then a big oil company comes along and buys your discovery. And that's the monetization point from the point of view of the investor. You don't have to wait all the way to the actual production, but that still takes quite a while, and it required a critical thing, which was it required people actually being there to buy those assets. So just at the moment, those people aren't really there, and that model broke down several years ago, and so far it's not fixed again. And as long as that's the case, I think that the investment case for pure exploration is very difficult. And that's why we've got some legacy assets, but the only real exploration we're planning to do in the near term is actually in the production license that we have, but it's still in the exploration phase. That allows us to do some low-risk exploration in places where the government want us to do it, and they're prepared to pay for it, because it'll be out of their cost recovery pool. Now, I don't think our situation is unique. And so I think there are other people in similar situations, other blocks, other countries where you can do this kind of thing. And so there will be exploration going on funded by that. And there'll be exploration going on funded by brave people. But at the end of the day, it's a very difficult sell right now to sell pure exploration. I think there's good reason for it. Once that model changes, if and when it does, then there'll be a new case for it.
So Aaron, is storage an easier sell? You're going to need enough natural gas to store.
No, I think I quite agree with Paul's comment. For the right project and for the right management team, there is cash available in the market. But let's not kid ourselves, it's a hard slog. You can have the best project and the best management team, but it is a lot of hard work to raise monies.
Thank you very much indeed. Well, I think probably we'll bring our evening to an end, or at least the formal part of it. Thank you very much indeed, Richard, for giving us your thoughts at the end there. Lots of interesting themes seem to have come together. So thank you to Paul Blakely from Jadestone Energy, Jeremy Asher from Tower Resources, and Aaron for stepping in and doing the whole shooting match for Infrastrata. Please enjoy the refreshments, have a chat to anybody from LSE or our guests, and you'll be able to see the webcast in about 24 hours, and there'll be a link to that on the lse.co.uk website. Thank you very much, everybody. Thank you.